Oil prices have fluctuated since October last year, when Houthi rebels in Middle Eastern nation of Yemen began attacking shipping lanes in the Red Sea and the Gulf of Oman. Joining me now is Vivek, Dhar, Commodities analyst at the Commonwealth Bank. Vivek, thanks for your time. Just how much disruption are these Houthi rebel attacks causing to global shipping lanes?
So look, even if we look outside commodities, we're talking 13% of global trade goes through that Suez Canal and the Red Sea. So it is a significant volume in terms of the global picture. And adding to that, if you look at container freight, we're talking 30%. So it is a significant disruption when you talk about how much trade flows have to now divert and the extra cost of that. So this is something that is impacting, thinking about oil, you're thinking about LNG, but just broadly all trade is really looking at this very, very closely.
Yeah, the United States, the UK, they've now started launching airstrikes against the Houthi rebels in the past sort of month or so. But right now, these strikes don't really appear to have stopped them or discouraged them. So what are shipping operators doing in the Red Sea?
So look, in terms of the options open, when we particularly look at going through the Red Sea and the Suez Canal, you're basically having a tenfold increase in your insurance premiums. So if you decide to go this route, you're definitely going to be paying for it. The alternative is to go around Africa. And that's something that will effectively add about 14 days to your journey, and as a result will increase costs. Now, the reason why this is all quite critical when we talk about oil is if you combine oil and oil product flows that typically have gone through the Red Sea and Suez Canal, particularly post the Ukraine war, we're talking almost a repricing of about 6.5% of global oil supply. And that is what the market has to digest. Now, that might not reflect in oil prices directly, but what it will do is the realized oil price that you get for the consumers, particularly in Europe and Asia, those are going to be higher. And that is going to spread to the market at some point. So it's certainly something to watch, not reflected in oil price indices, but certainly in terms of consumers and what they're paying. We're seeing this play out.
And at the same time, on the other side of the world, there's bitterly cold temperatures in the United States Midwest. So what's that doing to oil production right now out of North America?
Yeah, look, in terms of what we've seen, North Dakota has been impacted in the Midwest, and we're talking 0.65% of global supply sideline. Now, the risks for that, if you look at the entire state, it's about 1.2% of global supply coming from it. So that's really what's at risk. But in the scheme of things, I'd say the market is paying some attention to that, but recognizes it's more temporary. But it's what's happening right now in the Red Sea that's attracted the most attention, because initially that was seen as a 72-hour warning. And now that's become almost an indefinite, we'll let you know when this becomes safe. But this entire process right now is everyone is now guessing when will those shipping lanes open again.
Turning to iron ore, were you surprised with the strength of the iron ore price earlier this year, touching about $144 a tonne?
In terms of what we saw with iron ore prices, we saw a massive dislocation between where iron ore prices almost finished 2023 and what happened in December in terms of China's steel output. We saw China's steel production fall almost 15% year on year in the December month alone. And if you look at that, it doesn't make sense why iron ore prices lifted as high as it did. In our view, markets looked well ahead. They saw the fact that stimulus was on the table for China, and they thought, okay, steel demand hopes should increase, particularly via infrastructure investment, and prices almost reflected that future demand hope. But the current conditions are still bad. And that is something that we're starting to see play a bigger role in setting the price right now. And that explains why iron ore for us has come down from 144 to now under 130. And just given how negative those steel margins are currently, we think we could see prices threaten that $100 a tonne mark.
Vivek Dhar from Commonwealth Bank, thanks so much for your time today.